Let's start off, not to pitch you against one of your colleagues. Obviously, you folks are kind of in different departments, if you will, here. But of course, I'm sure you've seen his general take on some of these rallies that we've gotten over the past few weeks and months here. The idea that this is just a bear market head fake here. Do you buy that?
No. Couple things. I think Katie really nailed why the market's weak today, but strong last week, which is, look, with rates where they were going into last week, it's a big competitor of stocks, but as 10-year came down, that really allowed the reality that third quarter earnings were very good. Companies are reporting good earnings. The estimates for this year and next are not dropping, which means as we sit today, we're going to see 12% earnings growth next year. Maybe it won't happen, but there's no sign it won't. So I think all the market needed was rates to come down, and that really lit the market higher. Now today, the reason why the market sold off is you're seeing rates go the other way. As Kate pointed out, rates have gone up a little, and that's why it's weak in the market. So the stock market really is being driven off of the bond market because the fundamentals are coming in pretty good.
Well, that sort of shows and I guess reflects some of the day-to-day moves, the day-to-day volatility, if you will, here, Andrew. The longer-term trend, though, I mean, when you look at technical levels, when you look at corporate fundamentals, which according to you, at least this earnings season, has been relatively decent here, does that sort of put together the idea that there is much more upside to come rather than more of a downside?
Yeah, I mean, the issue with a lot of upside is the market's not cheap. Even going into next year, you're still looking at a market PE that's pretty high. So what has disappointed the bears is the denominator, the E, hasn't collapsed the way they believe. But what's frustrated the bulls is it's hard to see a lot of upside with 10-year at 4.5% to 5%, and the market trading in multiples. So I think we'll get a rally into year end, but I'm not sure that there's a lot of upside, as we look out into next year.
And I want to talk a little bit more about the bond market because, okay, the 10-year yield, it's not at 5%. It's back to 4.6%. It's still at 4.6%, which is very high looking at recent history. If we stay near these levels, say 4.5% to 5%, what pressure does that put on different parts of the equity market, and what parts actually manage through it?
Well, I mean, overall, the market's trading kind of in a valuation that's okay in today's, where the 10-year is. If you push north of 5%, stock market's too expensive. So I think the stocks to focus on are companies where their fundamentals are better than expected, because I have a hard time seeing valuations being repriced higher. So I think you want to focus on companies doing well. And this is why the Magnificent Seven are leading the market. I dismiss the market seeing poor breadth. The reason we're seeing poor breadth is those companies, the very largest, they're reporting the best numbers, the strongest. Not all of them, but overall, cumulatively, they've had the best revisions. So I think that's where you want to focus on companies that are exceeding fundamentals, because I don't see a lot of PE expansion.